All right, let's talk about something that's honestly one of the hardest, but also one of the most important skills in all of investing: how to ride out the market's ups and downs without completely losing your cool.
So picture this. You log in to check your portfolio, your heart just sinks a little, right? That number staring back at you is lower than it was last month. You get that awful feeling in the pit of your stomach. The big question is, should you hit the panic button?
Well, for anyone who's in this for the long haul, the answer is a big, firm no. Believe it or not, these price swings, they aren't a mistake in the system. They're actually a feature, not a bug. It's kind of like the price of admission you have to pay for the chance at long-term growth.
Okay, so how do we get comfortable with this feeling? Well, it really helps to pull back the curtain and understand what's actually going on. So let's dive into this idea of volatility.
You know, one of the best ways I've heard it described is to think of volatility as the market's noise level. When everything's kind of calm and predictable, the noise is just a low hum. But as soon as some uncertainty gets thrown into the mix, that noise gets cranked way up, and you see prices bouncing all over the place. So where does all this uncertainty, this noise, come from? Honestly, it can come from just about anywhere. We're talking about inflation numbers, changes in interest rates, what companies are reporting in their earnings, all the way to big geopolitical events, or even just domestic policy like an upcoming election. All of these things can dial up that market noise.
Right, so if volatility is this noise level, you're probably wondering, is there a way to actually measure it? And the answer is yes, absolutely. There's a specific tool that the pros watch like a hawk to get a read on the market's mood.
And that tool is the VIX, the Volatility Index. You might have heard it called Wall Street's fear gauge, and for good reason. It's basically trying to measure how much the S&P 500 is expected to bounce around over the next 30 days. In a nutshell, it's a snapshot of how anxious or chilled out the market is feeling.
And you can really feel the difference. When the VIX is low, it's like smooth sailing. The markets feel calmer, the news headlines are pretty quiet. But when that VIX starts to climb, oh boy, that's when things get stressed. The headlines are screaming at you, and you get those wild, sharp price swings day after day.
But, and this is so important, a high VIX does not automatically mean a crash is coming. It just means there's a lot of fear. For instance, say some big news about new tariffs drops, right? The VIX could spike like crazy. It would feel totally chaotic. But what we've seen time and time again is that the market can be incredibly resilient. Fear is one thing, but reality can be something else entirely.
Okay, so we understand the noise. We know how to measure the fear. But what do you actually do about it? How do you build a strategy that can handle all this chaos without derailing your goals? That's what we're getting into next. This is the playbook.
And before I just give you a list of rules, I want to show you something. Let's look at a powerful real-world story that repeats itself throughout market history, and it perfectly illustrates why sticking it out is so critical.
So check this out. It's actually not that unusual for the market to drop almost 20% at some point during a single year. Now just think about that for a second. Imagine opening your account and seeing it's down that much. That is a gut-wrenching moment, and it would test anybody's nerves, for sure. But here's the incredible part. In so many of those exact same years, the market staged a huge comeback. The people who got scared and sold, they missed out completely. It's amazing how often the market not only erases those losses, but actually ends the year with a really solid gain. That is the prize for having patience.
All right, so how do we make sure we're the ones who are there for that comeback? It really comes down to these 4 key principles. First, you've got to diversify. Don't put all your eggs in one basket. Second, make sure your investments match your timeline. Third, invest regularly, which is something called dollar cost averaging. Now, those 3 are your foundation, but honestly, it's this last one, controlling your own emotions. That's the real game changer. It's what separates successful investors from the rest.
And this really gets to the heart of it. That urge you feel when things get scary, the one that tells you to just sell everything and hide in cash, it's a powerful feeling. But trying to time the market to jump out and then jump back in at just the right moments, it's a dangerous game. You have to be right twice, and let me tell you, very few people ever pull that off consistently.
Okay, so I know what you might be thinking. Does staying the course mean I should just set it and forget it forever, no matter what? And the answer is, not exactly. There's a huge difference between reacting out of fear and responding logically to a real change in your life.
Look, there are definitely good reasons to adjust your plan. For example, maybe your life circumstances have genuinely changed. You were saving for a house in 10 years, but now you've got a great opportunity and you need that money in 2. that's a totally valid reason to make a change. Or maybe after some calm, clear-headed thinking, not in the middle of a panic, you realize you're just not comfortable with the amount of risk you're taking. These are smart, logical adjustments.
So what are the bad reasons to make a change? Basically, all the stuff we've been talking about. A scary market dip, a week of screaming headlines on the news, some chatter about interest rates. This is just the market being the market, tearing up a solid, long-term plan because of this daily noise, while that's the classic recipe for buying high and selling low.
And all of this really brings us to one final powerful idea. Your biggest advantage as a long-term investor, your secret weapon, if you will, it isn't some hot stock tip and it's not some complicated trading algorithm.
It's patience. That's it. Your goal isn't to outsmart the market or predict its every move, because that's impossible. The real goal is to create a plan that fits your life and your goals, and then have the strength and the discipline to just let it do its thing.
So if there's one thing you take away from all this, let it be this. If nothing fundamental is changed in your personal situation, then nothing should probably change in your investment strategy. Sometimes, the absolute best move you can make, and often the hardest, is to simply do nothing at all.
And so I'll leave you with this question to think about. Take an honest look at your own approach. Is it truly built to last for years and decades? Or is it maybe a little too vulnerable to getting knocked off course by the noise of right now?